Hello, everybody, and welcome to what is the first Trusted Trustee podcast for year 2026. Welcome and Happy New Year. And as usual, I'm joined by Tracey Besters in the Southern Highlands of New South Wales. Hi, Tracey, and Happy New Year to you as well.
Thanks so much, Darin. Happy New Year. And can you believe that we're in 2026 and feels like the year is flying by already?
I cannot, and we record this on the 22nd of January, so we're nearly at the end of the first month of 2026, which is just
Very.
such a scary proposition. I can't begin to tell you how scary that is. But of course, this podcast is brought to you by Superfund Property Valuations. Take the tension out of tax time by making Superfund Property Valuations your number one choice for all your SMSF property valuation requirements. Order a report today by filling in your details online at superfundpropertyvaluations.com.au and let Superfund Property Valuations take care of the hard work. And who doesn't want anybody else to take care of the hard work? I'm always happy to let somebody else do the hard work. And I know
Me too.
William Spark and the guys at Superfund Property Valuations will do a great job for you. And I think they've got a very busy 2026 ahead of them as well as us. Now, we're just today in the lead up to the new year, as we've wished everybody Happy New Year. We're just going to discuss a few things that we can look forward to, probably in the immediate to short term to medium term, I suppose, for 2026. Some of the stuff that's
Yeah.
still on the table, and some of the stuff that you will no doubt see unfold as we progress further into the calendar year. And
Mhm.
look, Tracey, unfortunately, we're going to have to start with Division 296. I know that we keep saying we're sick of talking about it, and we are sick of talking about it, to be honest. But look, our friends in Canberra, they never stick to what they're supposed to. Any of the listeners in our last podcast, I said it was a win, I think, because we weren't going to see the legislation before the end of 2025. I had reliable sources that told
You
me that.
did. You did.
I think those sources are going to have to be sacked now. Uh, Basically, because lo and behold, on the 19th of December, yeah, that's right, just when everybody was closing their offices and preparing for Christmas, the
Mhm.
government dropped the draft legislation for the amended Division 296 tax policy, which meant most people who are stakeholders in the SMSF industry had the whole of Christmas to look forward to digesting what the government had put on the table and weren't supposed to do that until the year had ticked over.
Mhm.
Nevertheless, interestingly enough, there were a few developments that we didn't see announced in October last year. And so we're
Mhm.
just going to touch, we're not going to go through the whole thing, but we're just going to touch on a couple of the things that we've noticed or have been alerted to the whole community that exist now that we didn't see in October. So let's
Yeah, exactly.
start with, sorry, Tracy, let's start with the total super balance, because the total super balance now, and this has caught people by a little bit by surprise, the total super balance will now play a different role in the calculation of the Division 296 tax. Tracy, I'm going to hand it to you to try and explain what's going on here.
Yeah, so I guess there's a couple of things with total super balance, Darren. So originally we were thinking that the total super balance, we were going to have all of these increases and decreases and additions and subtractions, and all of that would kind of then throw out this figure, and then that would be a determining factor as to, what is our Div 296 going to look like? Well, that's not quite how it's going to play out now. So I guess from my perspective, how it's going to play out now is that total super balance really is coming into, are you in the fold or are you out of the fold? So if you've got a total super balance of over $3 million, we'll talk about the timing of that in a second, but over $3 million or over $10 million, then you're in. And if that's the case, then we need to have a look at this concept of earning to determine, how much you're going to be. taxed under Div 296. So there's probably, I think, look, there's less reliance on total super balance than there was in the original stuff in terms of calculating the Div 296 liability, but total super balance is still definitely on the table from a are you in or are you out concept.
Yeah, so I think previously it was measured on where are you at 30th of June, and if
Correct,
you were
that's
over the
right.
threshold, you were caught.
Yes.
But the interpretation now is that it doesn't matter. They're going to have a look at your TSB on the 1st of July and your TSB on the 30th of June. And if either of those two amounts
Yeah.
over the
You're
threshold,
in.
either threshold, you're caught.
Yeah, and that was a new development, Darren. We didn't see that one coming in the sense of the
No,
1st July figure. Obviously,
yes.
we knew about the 30 June figure because that's kind of, the first part of the process. But the new part was that now, if you are over on 1st of July, or you're over on 30th of June, you are caught in the net of Div 296. So the strategy that people might have been thinking very cleverly, we're going to just, offload things during the year and we're going to be under at the end of the year, even though we're over at the beginning of the year. Sorry to say, you're still going to be caught by Div 296 in that particular year. So that is a new development.
Yeah, I suppose the only thing is if you want to prepare for this, the only time really specifically that will be still relevant is in the
Yeah,
lead up or during the 26-27 financial
7
year,
years,
I
that's
think it is.
correct.
So if you
Yeah,
can still get below the threshold during that financial year, you can still get away with it. Other
yes,
than that, you're looking at years down the track where potentially you could at a particular 30th of June get below the threshold. You'll still get
yeah.
caught if you're over the threshold on the 1st of July. But for those subsequent years, if you can keep it below the threshold, you'll still be okay. But as you can tell by my, supposed simple description of it, it is a little bit more intricate than, what we've been discussing, what the whole SMSF sector had been discussing
Yes.
in looking to manage this tax and whether or not you're up for a liability or not.
Yeah, exactly, Darren. And so just to clarify, or just to, reiterate what you've said there, for the very first year, there's a transition. So, if this legislation is passed in its current form, which, the indications are that it probably will be, with some tweaks, hopefully, but, in the general sense, passed, then it will come into play 1 July 2026. So the very first assessment year is from that 1 July 26 to 30 June 27. But the transition in that year is if you are over the TSB of $3 million on 1 July 26, that doesn't impact that first year. So provided you're below on 30 June 27, you would be outside of the net of Div 296 only for that first year.
Yeah,
But
yeah.
moving forward, you're going to be caught if you're over on either the 1st of July or 30 June. So yeah, we've got that first year. But there's still all of the other things that we talked about in our podcast last year, of all of the other considerations around trying to get below the $3 million. You've got to think about all of the other, capital gains tax positions and everything else going on in that regard.
Yeah, no, as I said, that's probably the most significant change as to because it was not anticipated, basically.
No, that's right.
There
Yeah.
was no reference to it in October when the amendments were announced. So
No.
this was a bit of a surprise for everybody in the sector. One other thing that piqued my interest in one of the submissions about the
Mm,
tax, and of course the submissions closed on the 16th of January, was from
mm,
from CPA Australia, and they were raising the issue that we don't know how franking credits are going to be treated in the
mm,
calculation of this tax. And I
mm.
thought to myself, yeah, that's actually a really good point because that will be significant in how you declare your dividend income, whether or not it's from a net position or a gross position. That
Yeah.
does make a difference.
It makes a huge difference, Darren. And I think that is a great submission that CPA made. And I think also maybe there was someone else that mentioned it as well. I can't remember who it was. But the point of that is that when you lodge your tax return, so you actually declare your dividend income at gross. So it's grossed up for whatever franking credit you've received on that dividend. But in the tax return, the SMSF annual return, you then get a credit, corresponding credit for whatever the franking credits are that you've received. So
Yeah.
yes, you're paying the tax is calculated on the grossed up figure of dividend, but then your net tax that you pay is after the franking credits have been allowed. The DIB 296 doesn't seem to work that way. It seems to be that you're going to be assessed on the grossed up amount because the definition of earnings is basically taxable earnings, if you like, which includes the franking credit, but there's no allowance anywhere in the DIB 296 calculations for the appropriate franking credit to come off. So I guess this submission is on the basis of, well, really, you're kind of double taxing something that ought not to be taxed because it's being taxed in the beginning at a corporate level, which is why we have the concept of franking credits and imputation credits at the receiving end.
Yeah, that would be the ultimate irony, wouldn't it be? Because franking
Ultimate.
credits were brought in so that the company doesn't get taxed and we don't get taxed on the two
Yeah.
levels. And to bring in this tax to basically annul the double taxing principle
Yes,
would be kind of, counterproductive, I would suggest. But look,
totally.
who knows how the people in Canberra think? They obviously don't think
Yeah.
the same way I do.
No. Or me. And
Which
you
I
know,
like to actually, well, I'd like to actually think it's a more fair and equitable view than I have, but you know, I'm not
and you
opposed.
know, the concentration of SMSFs that are invested in Australian equities, Darren, you mentioned that before our podcast started, that, we've got a high concentration of SMSFs that do invest in Australian equities. So certainly this whole concept of franked dividends and that, that anomaly, that we think it looks like an anomaly in that the way the legislation has been drafted, certainly is going to come into play for quite a number of SMSF investors.
Yeah, it's a bit of a catch-22 as far as that goes, isn't it,
Mm,
Trace? Because not only SMSF investors, but investors across the board in Australia have an ASX bias simply because
yes,
of the incentive to receive franking or imputation credits on their dividends. Now,
yes.
if they're attracted to it because of that, but then you annul the effect of the franking credits on the calculation of the Division 296 tax, it's almost like a double whammy. And a catch-22 is that I went there because I wanted the franking credits, but now I'm going to get
Mhm.
penalized because you're not going to count the franking credits in the Div 296 calculation. So I think that is one area that they will have to address. And I have absolutely no doubt that when this discussion becomes maybe more prevalent, this will be one of the white hot things going forward to say that hang on a minute, hang on
Yeah.
a minute. I mean, look what happened the last time they tried to touch franking credits. That pretty much brought down a federal party politician.
It pretty much,
Weird how
yeah.
that is. That was pretty much the end of Bill Shorten's reign, wasn't it?
Yeah, it was
Because that
absolutely.
was the unlosable election that went down the tubes for him, and he never
Yep.
recovered from that. So
No,
it's not a small issue. And
no.
believe me, I went to some of those parliamentary committees that they took around on a roadshow. I still remember that. And I can tell you, I don't think I've been in a room with SMSF trustees before where the tension was so thick that you could cut it. And actually, the one I went to in Chatswood, there was a scuffle. It was
Oh,
actually
really?
a physical scuffle, not between the pollies and the attendees, but it was among attendees, I think, who I missed it, but it happened before I got there. But there was a scuffle. I don't know whether or not it was a disagreement as to the way forward, but
Yeah,
I can tell you tension was very, very, very high. White hot, I would
absolutely.
describe it.
It sounds like
So
it.
if that's anything to go by, I think the more
Yeah,
air this issue gets, maybe the more um, aggrieved SMSF trustees might feel about, hey,
for
hang on,
sure.
what are you talking about? My franking credits aren't going to be taken into account.
Yeah, it doesn't make sense at all. It really doesn't. And I think the other interesting thing that came out of that draft ledge, Darin, that when I was reading through it in the EM, was around kind of the process of how the applicate or the proportion and the allocation of earnings are going to be fed to members, and what is the government looking for there? And that was a question that we had around, well, what is going to be acceptable? What is, how are we going to do this? What is fair and reasonable look like? And so now the government have basically said, well, they are going to be effectively, and it hasn't come, we don't know the detail of this definitely yet, but it's basically going to be an actuarial calculation. So you mentioned about valuers being really busy, and shout out to William Sparks, going to be really busy in the next few months. Actuaries are going to be very busy in the lead up to this Div 296 as well, because they are going to have to build some systems and processes around this whole actuarial calculation for people who are affected or who are in the net of the Div 296 provisions.
Yep, lots more work for a lot of people, I think,
Yeah,
is the
exactly.
bottom line. I think that's something that we can all agree on, that no matter what
Exactly.
happens, lots more
Yeah.
work, lots more administrative work, unfortunately,
Yeah,
for a
I
lot
was
of
going to say the
people.
same thing, administrative work, because the other thing that was in this thing is around a cost-based reset, and so there's going to be the option, or I guess the requirement, if you like, for there to be this allocation or reset in your accounting systems for what is the CGT cost base of your assets at 1st of July 2026. And then that's kind of going to be your starting point moving forward. So we were very concerned about unrealized gains. We were really worried about that. That's gone now. It's not going to be unrealized gains. It's going to be realized gains. So that's a better thing. But, just there's all those little idiosyncrasies and, unintended effects, or maybe they're intended, I don't know. But all of this flow on, that, people at face value don't realize has to happen in the background to be able to meet these requirements. So we're still, I think, a fair way off having certainty around what the practical day-to-day requirements are for Div 296.
Yeah, I think it just goes to show that, oh no, this is just a simple thing affecting a few people, it's no big deal. I don't think there's anything that can be defined as that. Whatever
No.
happens, it is going to have a significant effect.
Yeah.
88,000 or not, it's still going to have a significant effect. And that's something that we can all, and I say this facetiously, look forward to in the future. But let's not get bogged down, because we have spoken about Div 296 so much
So
over the
much. Yeah.
last six to 12 months. Let's move on, because believe it or not, there are other things happening
There are other things.
in the
Yeah, there
SMSF
are.
space. It may not appear to be, because of the obsession with this tax, and well-founded obsession as well. But there are
Yes.
other things going on, and Trace, you're gonna alert us to some of them.
Yeah, there's a couple of things I wanted to mention that people don't probably realise, that there's all of this, legislation and regulations that are sitting in government, sitting at some stage of, either in the House of Reps or the Senate, have been sitting there for quite some time. And we know that Parliament next meets on the 3rd of Feb, so they'll be coming back from, well, they kind of had a short thing back, didn't they? But in terms of their general business, they're coming back on the 3rd of Feb. And there's a few, it's like 3 particular bills that are in government or in front of Parliament that do have, sorry, one's passed. I'll mention that first. The one that's passed, and we kind of touched on it last year, Darin, is the payday super. So
Oh, yes.
we have got payday super coming in. It's been given royal assent. Was given royal assent in November last year. Comes in 1 July 2026. And for people who with their own SMSFs, it's going to be just, again, more admin really, because, you at the moment, if you have employer contributions going in, those contributions may only be going in 4 times a year, being the quarterly requirements for superannuation guarantee. Now, if you're paid weekly, you might have 52 contributions that will be going into the super fund. So there's going to be a little bit of a transition, I think, is going to be the most complex part of this payday super for people, because if you receive your April to June requirements, so your April to June quarter superannuation guarantee, well, that still won't need to be made until the 28th of July 2026, but then you might actually start receiving your July payments earlier than that. So, it's this allocation of when these contributions are received. And I guess, the super fund is taxed on them when they go into the fund. It counts towards your concessional contributions cap when they go into the fund. So you might just, if you're doing personal super contributions or catch-up contributions, just be careful of that crossover at the beginning of the year in terms of, payday super and that transition interaction. So just a little tip there. We'll probably talk about
Yeah,
that closer to the end of June anyway.
it's an interesting one, Tracy.
Mm.
And for the trustees out there, it's more around what the employer's obligations are. But as Tracy
Yes.
said, it will have implications on when you receive contributions, if they are employer contributions, because that's
Yeah.
significantly going to change. And all I can say is expect some hiccups along the way.
Definitely.
Tracy's already obviously alluded to the crossover between the two timing dates is going to be a little bit tricky. Um,
Yeah.
One of the other things is they're carrying forward any short payments on payday super. So if the employer somehow mucks up the payment and there's a shortfall from one month to the other, then the
Yeah.
next month's contribution will go to repair that shortfall first, will be
Yes.
allocated to repair that shortfall first, and then carry on business as usual. But if the employer
Yeah.
doesn't realize that there was a shortfall, that shortfall obviously can just go in perpetuity until
Yes.
someone finds out about that. I'm pretty sure it
Yeah.
won't go in perpetuity because they will get notified and probably fined because they haven't
Yeah.
been paying the right amounts. But there's these sorts of hiccups that not from the trustee end, but more from the
No.
contributor's end that you're probably going to see. One of the other things that I think is not so good for people who have got to make contributions is that they're changing the clearing houses that are
Yeah.
available to employers as well. The ATO was a clearinghouse, or is a clearinghouse at the moment. I don't believe that they're
Yeah.
going to do that anymore. Unfortunately,
No.
that's the clearinghouse facility I use. So
Yeah.
there's going to be, so I have to change what I'm doing, but there
Yeah.
is going to have to be a wide scale, broad scale change as far as
Yes.
operation goes. And we all know that when something like that happens, there are going to be teething problems. And I think the thing
Absolutely.
that, again, this isn't for a trustee audience to really worry about, but the thing that employers will worry about is when the contribution is made, as in when it's recognized to be made, is changing as well. So before,
Yep.
if I hit the button for it to go to the clearinghouse, basically the contribution is considered to be made from my end, and I'm devoid of any more responsibility as far as looking after my employees' superannuation goes. Now,
Yep.
it's when the clearinghouse makes the payment to the super fund, which means that
Yeah.
I could easily fulfill my obligations of the time period. Is it 7 days?
If under payday super, it will be
Yeah,
within 7 days.
so it's 7 days. So I could get my payment in within 7 days. What happens if they're on the Optus internet and we have one of those horrible, situations where the whole system collapses and we don't know when it's coming back up and blah, blah, blah.
Exactly.
Effectively, if that goes beyond that 7 day period as an employer using that
Mhm.
clearinghouse, I get penalized because the clearinghouse didn't provide the contribution to the super fund
Yeah.
within the 7 day window, which I think is grossly unfair. But
Yes.
we will see how that plays out.
Yeah, and Darin, the fact that you were using the ATO clearinghouse gave you a benefit, gave you an advantage in terms of that timing, because a lot of the third party clearinghouses, effectively they will have a cutoff well before the time frame. So they'll have a cutoff maybe 14 days, sometimes longer, before the contributions are currently due. For that reason, to be able to help, prevent, I guess, or circumvent any issues. But from a trustee perspective, though, I guess just a couple of things to be mindful of in the lead up to this payday super. And we will remind people when we talk about end of year stuff in a few months, but a couple of things to do is make sure if you've changed bank accounts or you are going to change bank accounts towards the end of the financial year or early in the new year, make sure that has been, communicated properly. Make sure that those bank accounts are connected properly through to your clearinghouses and through to SuperStream, who's going to receive your contributions. If you've got new employees or new members of the fund coming in, just make sure that, again, all of that information is set up well in advance, so that you don't have this issue in this transition period. But no doubt we're going to be talking about, horror stories of payday super and
Yeah.
things, should have gone better and they didn't, because that's just life, right? So,
Yeah, and the last thing I'll say on all of this, in typical government fashion, we already know that the infrastructure is not established
no.
to facilitate this change. So I'm just going to put that out there. 22nd of January, 2026. I'm declaring it nothing new, that we already know the infrastructure is not set up to
Yes.
deal with it. So just be warned about that, because it
Yeah.
could be quite a bit of chaos come 1st of July 2026. But we won't dwell on payday super, because
No.
just a little relevant for trustees, more employers. What are some of
Yeah.
the other bills that we're talking about here,
Yeah,
Tracy?
so there's another one that isn't specifically for SMSFs again, Darin, but will have an impact with SMSFs, and it's called the Corporations Amendment Digital Assets Framework Bill. So the government have introduced this bill. It's in the House of Reps at the moment, and it's basically the government's commitment to try and modernise Australia's digital asset framework, and make sure that it's that the digital assets are regulated, so that we've got protection for the consumers. Bring digital assets into kind of this realm of financial product and the definition of what a financial product is. So the bill is going to introduce a couple of new financial products. The first one is called Digital Asset Platform, and the second is tokenized custody platforms. Now, let's not go into the definition of, tokenized custody and tokenized assets and tokenization, but just understand from a trustee perspective that there is going to be some noise around what is a financial product and, what protection mechanisms do end users have, and whether SMSFs will come into that realm or not. But what is that protection is a protection for these investments in these products, if they are going to be a financial product, and how does that, does that change the digital asset space? We know there's a lot of noise with SMSFs and crypto, SMSFs and other kind of tokenized products, NFTs, etc. There's a lot of talk and a lot of momentum gaining ground in the SMSF space with these particular type of assets. So I think this is a good framework, if it's introduced in its current format, and if it's actually passed in its current format, to help understand and help create some clarity and certainty in this space.
Yeah, like you say, Tracy, I think this is relevant for the SMSF space, simply because cryptocurrency and other digital assets seem to be gaining popularity among SMSF trustees, particularly probably the younger cohort who are looking to start an SMSF. So it will have implications for them, because I don't know the ins and outs of this legislation, but I believe um, with the inclusion of the definition of financial product
Yep.
for the two items that Tracy said, I'm not going to try and repeat them. I think it's got implications for any cryptocurrency platforms out there.
Platforms, yes.
So they can get away with calling themselves a service, if you like, because it's more or less like a trading and custody platform, I think,
Yes.
how some of these work. So at the
Yes.
moment, they don't need an Australian financial services license in order to provide that service. Unlike, say, for example, a fund manager has to have an AFSL or something like
Yes.
that. So if they're brought into that fold, that's a lot more compliance issues that they have to deal with. And of course, the way you operate with an existing digital asset platform may change dramatically. It
Mm.
may even mean a pause of the service while adaptations are made to the new
Yeah.
legislation. I don't know. I can't foresee that, but that is the implication that some of the digital platforms at the moment may be forced to get an AFSL and change the way they operate. I don't think it'll change the way they operate from the services they provide and what they're doing
No.
currency. Currently, it will just be a matter of, okay, they've got an extra compliance hurdle to navigate, and they're going to have
Yeah.
to do that once this comes into play.
Yeah, exactly, exactly. So anyway, that's is that going to create more complexity? Probably. Will it create more protection for the consumer? Hopefully, right? So that's kind of my take on that. So that's currently sitting, like I said, in the House of Reps. It was introduced and read on the 26th of November. Still sitting there. Don't know whether that's going to have a huge amount of priority with the government with Div 296 and a few other things. No doubt they've got on the table, but we'll see how that one goes. And the other one that
Come
I
on, Trace, are you telling me that there's going to be more complexity when the government gets involved? No, we don't see that, do we?
my half glass full, half glass full. The
Sorry, I
last,
interrupted you. There is
oh,
one
good.
other relevant piece of legislation
Yeah,
as well
yeah,
that we
just the
can touch
last one
on.
for today. I didn't really kind of pay that much attention to this one, to be honest, Darin, and it was introduced by Senator Hume in September, and it's titled the Superannuation Legislation Amendment Tackling the Gender Super Gap Bill 2025. And the concept of this bill is to effectively allow spouses within a superannuation environment to split their balances. So whether you're in the same SMSF or whether you've got other superannuation accounts, it doesn't matter. It's not dependent on being in the SMSF or not. But it effectively allows you to say, well, I have more money in super than my spouse, so I can split some of my balance to my spouse up to the general transfer balance cap, which is at the moment $2 million. So I could say, well, if my spouse has 500,000, I've got 5 million, then I can, transfer 1.5 across to my spouse up to the 2 million, and we try and balance out our, even out our balances a little bit more. I think that's actually quite a good thing. I like this bill. I like the concept of what this bill is going to do. Will it be an administration nightmare? Probably not so much this one, because we already have the ability to do some super splitting with our spouses anyway. This just increases the amount that we can do currently, up to the kind of transfer balance cap limit. So I think it's a good one, but it's sitting there. You can do it on an annual basis. I don't know that I haven't really kind of followed the appetite by the government as to whether they want to accept this bill and where it will go from here. I don't know if you've heard anything on this one, but I think it's a good one.
I haven't heard anything on this one, Tracy. But
Mm.
look, if we're going to pick winners and losers right at the start of the year, I'll pick this as a winner, I think.
Yeah.
I know a lot of our audience doesn't get to see all of the commentary around the superannuation gender gap that we do, and
Mm.
it doesn't seem to be improving very much. A little bit, yes, but it seems to be going at glacial pace, I think they describe it as. So I
Yes.
think a bill like this would actually, dramatically help the situation, and we want that. I mean, we don't want women retiring with significantly lower balances than men.
Yes.
They stop working. So hopefully this bill will provide an avenue to correct that.
Yes.
And obviously, if we get more on an equal footing, no matter which sex you are, then that's got to be a good thing. So I give that a big green tick as well. And I'm declaring that that's my first winner for 2026.
We'll report back later in the year, Dan, in our final episode for this 2026 year to see whether that one actually did get across the line. But yeah, totally agree with you in terms of a winner. And I think it will actually help to reduce some of the potential strategy pressure. And I don't know if pressure is the right word, Darin, but some of the strategy pressure on withdrawal recontribution, because withdrawal recontribution strategies have been one of the mechanisms that advisors have used with their clients, and trustees have definitely used to be able to take balance out of one member and put it into their spouse. So if we've got another mechanism, which is not tax basis, there's no tax minimization, there's nothing along those lines, then that's also a positive for this particular bill as well. Because I know there's been a whole lot of talk around Part A, Part 4A anti-avoidance with withdrawal recontribution. Not sure I totally agree, with that, Part 4A avoidance. But having another mechanism, is certainly going to be beneficial for the industry as a whole and for that, gender gap.
So it looks like winner, winner, chicken dinner all round
Winner,
there.
winner, chicken dinner, this one. So if it gets across the line, we'll see. We'll see. We'll report, like I said, we'll report back. But it's our number one
Absolutely.
winner for the year.
Absolutely. Well, that's a very positive note, I think, to end our first podcast for the year. So we've run out of time because we've had too much fun as usual. So
Always.
thanks, Tracy, for your time today. It was great to see you, and I hope things are good down on the or in the Southern Highlands, I should say, of New South Wales.
Yes, things are good down here. Weather's nice. Bit of rain, but weather's nice, and I'm looking forward to many more fun, positive podcasts over the coming months.
Terrific, terrific. Thank you very much also to Superfund Property Valuations for their continued support. Thank you to my team for putting these podcasts together and making sure they're published on all the right channels. Don't forget, if you're liking our content on YouTube or accessing on YouTube, please smash the like button, hit the subscribe button as well. And most importantly, thank you to all of you for listening. We hope you got something out of it as usual, and we hope that you enjoy these podcasts as much as we enjoy bringing them to you. Until then, we will see you for the next episode of the Trusted Trustee podcast. Until then, travel safely and bye for now.
Thanks very much. Bye for now.